Hi, in this chapter we're going to talk about working capital policy and really just introduce what working capital policy is and talk about some very basic options when it comes to managing your working capital policy. This is really a whole area of finance. So this is more or less just a very brief introduction into this area of finance. All right, so with working capital policy, first of all, you'll remember from the previous chapter, your net working capital is just defined as being current assets minus current liabilities. So when we talk about working capital policy, what we're really talking about is managing our current accounts. So we're managing both our current assets and our current liabilities. And one of the primary goals in working capital policy is to be liquid, is to maintain liquidity. You want to be able to meet your cash obligations as they come due. So you've got to have enough cash on hand. It sounds very easy, but imagine if you're a multinational firm, you can imagine the amount of cash that travels through that firm on any given day, and it's not always as easy as it sounds. The importance of working capital, basically firms cannot survive without it. A lot of startup firms will actually crash and burn because of liquidity crises. So it's important to make sure that you have enough cash on hand to be able to pay your bills. And for a lot of firms, your current assets make up really a large percentage of total assets. Here you can see in this table the percentage of total assets that are made up from current assets. So, a firm like ExxonMobil that has a whole lot of fixed assets, meaning net property, plant, and equipment, they don't have, almost 20%. They've got quite a bit of current assets, but not nearly as high as some of these other firms. If you look, Walgreens at 32%, Merck at 33%, and let's go on over to IBM, where they've got 41.5% of their assets are in the form of current assets. So these firms have a team of people that are managing, a department of people that are managing their current assets and their current liabilities, and that's part of working capital management. So one thing we need to define is what's the difference between a firm's operating cycle and the cash conversion cycle, because this does impact a firm's working capital management. So I like this graph because I think this does a really good job of defining it, and your book has more specific definitions for each one. But look at this timeline where here, this is the operating cycle of a typical company, they say. Let's just assume, this could easily be a retail firm. It could be a manufacturing firm. Let's assume that this is a manufacturing firm for right now. So what you would do is you would purchase your resources, meaning you'd have your raw materials inventory, right? So you're purchasing all your raw materials so that you can go through and manufacture whatever it is that your company makes. Okay, and you purchase those from a supplier, and your supplier is going to give you a line of credit. So it might be 30 days, and usually those are very industry specific. Could be 30 days, could be 60 days, could be 90 days, could be longer. But at some point you're going to have to pay for that raw materials inventory. Okay, so that's the next step in the operating cycle. And then now at some point your raw materials inventory will turn into finished goods inventory, and so now you're ready to sell your finished goods inventory, and so you sell them Okay, and when you sell your finished goods inventory, just like your suppliers gave you a line of credit, you're going to give your customers a line of credit. And again, it tends to be fairly industry specific. And so, again, that could be 30 days, 60 days, 90 days, perhaps even longer. And then you finally, so it sits in your receivables for a while, right? And then you'd finally receive the cash. So by definition, the operating cycle is the amount of time it gets, the amount of time it takes to purchase your resources, purchase your, in this case, raw materials inventory, produce your product, sell your product, and then actually receive the cash from that product. Okay? Now, so that's where you see that's your entire operating cycle. Now, your operating cycle can be broken down into a cash conversion cycle and your deferred payables period. Your cash conversion cycle is basically the amount of time it takes for you to actually receive the cash from the time that you paid for your inventory. Okay, so here you're paying for your raw materials inventory. Here you're finally receiving the money from the finished goods. That's your cash conversion cycle. How long did it take you to go from cash out to cash in? Okay. The payables deferral period that's the amount of time that your suppliers gave you from the time they delivered the raw materials inventory until the time they required payment. And then another breakdown of the operating cycle, you can look at it this way. This is the inventory conversion period, and that is the amount of time it took to get from raw materials inventory to the point it was ready to sell. So to get to finished goods inventory. So how long does it take to get from raw materials to finished goods inventory? That's your inventory conversion period. And then your receivables conversion period is basically your accounts receivables period, right? How long does it take for you then, once you sell your product, to actually receive the cash? So you can see that the operating cycle can be broken down into many different parts, and so it's just good to be familiar with all these terms. Now, one thing I want to mention is, how does this tie in with working capital? Well, the longer your operating cycle, particularly your cash conversion cycle, the longer that is, the more assets you have to have, the more cash, liquid assets you have to have available to tie you over. You can think of it in terms of, if you had a job that paid you every 6 months instead of every month, you're going to have to keep a whole lot of extra money in the bank in the form of cash, savings, to hold you over until your next pay period, because your bills are due monthly. And so you're going to have to keep a lot more liquidity on hand so that you have enough money to pay your bills each month until your next paycheck comes in. So it's the same type of thing kind of with the company, same type of analogy. Or another way of managing that working capital would be to keep short-term lines of credit available to you, so that you could pay your bills. If you were to run out of cash, then you have credit cards, short-term lines of credit available to you that would help you get through until you got your next salary payment. So here's like the cash conversion cycle for Rite Aid. And so here we see that it basically takes them 47 and a half days. That was in 2012. and 2011, about 52 days to go from cash to cash. So from the time they pay to get their products, because a retailer is another good example in terms of looking at the cash conversion cycle. So from the amount of time it takes, or from the amount of time that they pay to get their inventory to the amount of time it takes for them to receive all the money from that inventory. And you can see here too the operating cycle, and the operating cycle is the sum of both the inventory conversion period, so how long it takes for them to convert their inventory, and then their receivables period, which is 14 days. So this is basically taking that graph in the previous slide and putting some numbers to it. So the cash conversion cycle's fairly quick here for Rite Aid. It would be much larger for, say, a manufacturing firm, for example. You have to think of working capital investments as a risk-return profitability trade-off. When managers manage their working capital, they do so based on how conservative or aggressive they may be. Some managers are very conservative, meaning that they are going to keep a much higher level of current assets available in case of an emergency, in case they need the liquidity. But we know that holding a lot of cash means that you're not earning a rate of return on that cash. So in essence, that means lower profitability, because they could be using that cash to earn, to make an investment, earn a return. But it's also lower risk because they have plenty of cash available to meet their needs. So there is a risk-return trade-off here. Lower profitability, but lower risk. If you're very aggressive, that means you're holding minimal amounts of current assets. So, if you run into some sort of an emergency, that cash may not be there. So you're holding a much lower level. But since you're investing that cash and earning a rate of return, your profitability is higher, but your risk is higher because you don't have a lot of emergency cash available to you. Here we're looking at a working capital policy, in essence, from an aggressive, moderate, and a conservative point of view. And the account where you'll really notice the difference is with the level of current assets that are being held. Notice that with the aggressive policy, we want to hold minimal current assets so that we have most of our money working for us and earning some sort of rate of return. And so that's what you see here. You see that they've got $35 million in current assets, as opposed to the other extreme, our conservative policy, where they hold a lot more in the way of current assets to be able to meet obligations and in case any sort of emergencies come up. So they probably have a little excess there in case they're off on their planning. The moderate policy, as you might expect, is right in between. So it's just in the middle of your aggressive and conservative. So probably the majority of your managers operate here. But another thing that's important to note on this table is that the expected rate of return for an aggressive policy is 15.38%, as opposed to the conservative, where it's just 13.33%. And the difference in the rate of return that's being earned by the firm is that is the fact that with the aggressive policy, you've got more cash invested in profitable investments, which again is why they have a low current ratio, which is current assets divided by current liability, and less net working capital holdings, which is, again, this is current assets minus current liabilities. So there's, again, your risk-return trade-off. Here we've got a higher return, but more risk because they could possibly be squeezed in terms of if there's a liquidity crisis. And here, they should have plenty of liquidity, but it's costing them some in the way of a return. Okay, so what is the optimal working policy investment? Well, there isn't a single one. It's very specific to individual firms. And just like everything else in finance, what you want to do is find that trade-off. You want to find, what working capital policy allows you to maximize shareholders' wealth. In other words, hold enough cash so you make sure that you're liquid and make sure you can even meet emergencies or have that short-term line credit available so that you can meet emergencies. Maybe not sitting on huge excesses of cash, which would cost shareholders because it's money not being utilized for investments. So you just have to kind of find what that trade-off is for your firm and try to operate there. Now we can also look at it we can also look at working capital from a financing standpoint, and that is, we've got short-term financing and long-term financing, and typically short-term financing is less expensive than long-term financing is because of the term structure of interest rates. If we have a typical yield curve, as long as it's not an inverse yield curve, you've got your short-term rates are going to be cheaper. And so again, in aggressive working capital policies, what some firms might try to take advantage of is maxing out their short-term loans to make investments in projects because the interest rates are lower. But the risky part of that is then you don't have those lines of credit available to you in the event of an emergency and you need that liquidity. So, the opposite of that would be leaving all your short-term lines of credit available to you in the event of an emergency and not taking advantage of any of that less expensive debt. So, we can look at working capital policy from a liability standpoint as well, and that's what we're going to do right here. So there's a risk of long-term versus short-term debt in that when short-term debt comes due, if you're not able to pay it, maybe you don't have the liquidity on hand to pay that short-term debt, what you would want to do is to be able to refinance it. There's no guarantee that you would be able to refinance, so you've got some risk there. And then the other risk that you have is that short-term rates are more volatile. They tend to be cheaper than long-term rates, but sometimes that's not always the case. And so, but at any rate, when you're trying to forecast what your cost of financing is, if you're using short-term debt, it's kind of hard to forecast that very accurately because short-term rates are more volatile. So here we're looking at the profitability and risk trade-off for different financing plans. And so what we want to do first of all is take current assets and divide it into two categories. We've got permanent current assets and what we call fluctuating current assets. And your permanent current assets are those assets that you absolutely have to have on hand in order to do business. And your fluctuating current assets are those assets that might fluctuate because of seasonal differences in your sales, or perhaps it's cyclical, so over years as opposed to within a year, like a seasonal change. An example that I like to use for this is, imagine a store like Toys R Us. And Toys R Us, their permanent current assets would be all the toys that you see, all the books and toys and everything that you see on their shelves when you walk into the store. Okay? They have to have all those shelves stocked with lots of toys and books and whatever, because they simply can't operate if they don't have inventory on their shelves. That is the minimum amount of inventory that they have to have on hand. So we would refer to that as their permanent current assets. I mean, it's the minimum that's necessary to have in the store all the time in order to do business day to day. However, you've got fluctuating current assets as well. And as you might imagine, Toys R Us, I would imagine that their peak shopping season, for their customers would be probably November and December, right? And so I would imagine probably beginning as early as early October. In October, November, and then the first part of December, their storage rooms in their back, their stock rooms, are probably filled to the brim with additional toys that they use to restock their shelves every evening. Okay, that would be a good example of the fluctuating current assets. Those are current assets that the firm or the store has to have on hand to be able to meet the Christmas demand for sales of toys. But come January 1, if Toys R Us experience the level of sales that they were hoping to experience, come January 1, you would find that they're fluctuating, or sometimes called temporary, current assets should be very, very low. Hopefully they sold all those extra inventories, all those fluctuating temporary current assets that were in their storage room. Hopefully they sold those during the Christmas shopping season, and so now they're just back to their permanent current assets that they need day to day, on their shelf. So that would be a good example of the difference between permanent and fluctuating current assets. Now, what we want to look at is there's different financing strategies for these different current assets. We have what's called a matching strategy, a conservative strategy, and an aggressive strategy. And within these strategies, what we want to look at is, how much of your assets do you want to finance with short-term debt, and how much of your assets do you want to finance with long-term debt and equity. Okay, in other words, long-term forms of financing. And again, there isn't any one combination that's optimal for all companies, for all firms. And it's really going to depend a lot on, how conservative or how aggressive management is. But let me go ahead and show you how some of these how these different strategies would look. We'll look at the matching, the conservative, and the aggressive. Okay, so here we have a situation where over time you've got a firm that has, and we can use the Toys R Us example if you want. All right, they've got their fixed assets. So their fixed assets might be their building. Okay, it's possible they lease their building. If they do, it would be a capital lease, which is binding. But let's just say for purposes of this example that they actually own their building. Okay, so that's part of their fixed assets. All the shelving, the lighting, displays, registers, all those things would be part of their fixed assets. And it looks like over time that this is a company that's kind of growing, so these things look to be increasing over time. And so then we have what we call our permanent current assets, which this would be the toys on our shelves that we need for everyday operations, just to be able to open our store doors every day. And again, as we expand our store over time, looks like we're expanding our growth, we're growing our store maybe a little bit over time. We're also expanding, what's on our shelves over time as well. And then these fluctuating current assets, and again, what's sometimes called temporary assets, this would be, like this would represent probably January. And then this would maybe be the ramp up before we get to Christmas. So this would be just prior to Christmas, and then this is like during the Christmas shopping season in January again. And so you would have these seasonal changes that occur with your assets. And so all of these together would make up your total assets. Okay, so under a matching approach to working capital management, what you would do is you would match, and this is where the name comes in, you would match short-term needs with short-term debt and long-term needs with long-term financing. That's why they call it matching. So, for example, your fixed assets, your building, your shelving, and all those types of things, those are permanent long-term needs. And so they're going to be financed with permanent long-term capital, long-term debt, and equity. Okay, don't forget equity. So long-term debt and equity. And then those toys and books that are on the shelf are also part of what has to be on the display in order to operate. It's the minimum amount of current assets that have to be there day to day in order to operate. So since it's really permanent, let's go ahead then and also finance that with long-term debt and equity capital. So the matching approach would say, okay, we'll take all our permanent and long-term assets and finance that with long-term debt and equity, and then just use our short-term lines of credit to finance this fluctuating temporary or fluctuating assets that are needed for seasonal changes. Okay? So that's how we would use financing under a matching approach. That's how we would finance our assets. Under a conservative approach, notice how it changes. Under a conservative approach, we're not only going to finance our permanent assets, permanent current, and our total fixed assets with long-term capital, but also we're going to really finance roughly about half of the level of fluctuating current assets with long-term debt too. In other words, what you want to do with the conservative approach is use as little of that short-term credit as you can. You know, just use a minimal amount because you're wanting to hang on to it in the event of an emergency. So in the event there's some sort of liquidity crisis and some need to access short-term capital, you have short-term lines of credit available to you. So you're financing almost everything with long-term capital and very little, just the very tip. So just that extra inventory those last couple months of the year with short-term debt. And as you might imagine with the other extreme, here's your aggressive approach. That's your other extreme. So we've got the aggressive approach. We're going to finance all our fixed assets and only a portion of our permanent current assets with long-term capital. And we're going to finance a good chunk of our permanent current assets and all of our fluctuating assets with short-term debt. In other words, we're going to use probably our entire short-term debt line of credit, take advantage of those short-term interest rates, and finance as much of our assets as we can with that. And then once we've exhausted our short-term debt, then we'll finance everything else with long-term, more expensive capital. Okay? But again, the risk in doing that is in the event of a liquidity crisis, we don't have a short-term line of credit that we can fall back on. So here is what it would look like in numbers. Okay, notice, and we'll look at it more from the financing standpoint, here's short-term debt and long-term debt. And like you would expect, short-term debt has a lower interest rate than long-term debt. And so we see with an aggressive policy, we have a lot more short-term debt than we have long-term debt, as opposed to the conservative policy where we have very low levels of short-term debt taken out and much more long-term debt. And of course, moderate is right in the middle. Okay, but notice, and this is what they're wanting to point out here, that notice because the aggressive policy is taking advantage of the lower interest rate for the majority of their debt. They have less interest expense then. Notice how their interest expense is lower than the other two scenarios. And so therefore, they have the higher net income. And also note, they also have the higher expected return on equity. Okay. And then you see here, again, I like to go the other extreme first. Here, the majority of the debt is long-term, so they're paying the higher 10% interest, so that's why your total interest cost is higher with the conservative approach, and then our net income is lower as a result, 3.6 million as opposed to 3.8 million. And also our expected rate of return on common equity is lower. And with the moderate approach, as you would expect, it's right in the middle. So here again, we see another example. This is with Burlington Resources. Now here we're combining both sides, the liabilities and the assets, okay? Because so far we looked at them separately. We looked to see, and we saw that an aggressive policy, didn't hold much in the way of current assets, and they used as much of current assets as they could in investing in long-term projects, and also in addition to that, they use short-term debt to try to finance those projects. So we're going to put the two together and see what it looks like. And so now you'll even see a bigger difference in the net income. So notice again here, remember we said with an aggressive policy, they're going to hold a small amount of current assets, the smallest amount of current assets that they think they can get by with. So they've got 35 million as opposed to the conservative, which holds excess current assets because they want to be super careful. Okay, and then of course moderate is always in the middle. All right, and then we combine that with what we're looking at in terms of financing, where with the aggressive policy, again, they're using all their short-term debt, keeping their interest cost low, and with the conservative policy being the other extreme, using mostly long-term debt, so their interest cost is higher. So when you combine the effects of both of those things together, what we find out is the net income for the conservative policy is only 3.4 million as opposed to 4 million for the aggressive policy. Okay, and the moderate again would fall right in between. So while it might look attractive and say, oh, well, why wouldn't you go the aggressive policy? Understand all that though is operating on the assumption that they're not going to run into any sort of situation where they might have a sudden need for liquidity, because if they do, they're in a whole lot of hurt because they don't have it in cash and they don't have it in a line of credit, and a lack of liquidity can certainly drive a company out of business. So you would have to hope that they have forecasted their cash needs very accurately in order to be able to operate under an extreme version of this policy. But like I said, it's a risk-return trade-off. It's high risk, but higher return, 15.4%. Here we've got much lower risk, very low risk, and a lower return, 11.3%. And again, most managers operate somewhere in the middle here. Okay, so what do we mean exactly when we talk about short-term credit? There's various sources of short-term credit. You have the type of short-term credit that occurs just because of operations. It just occurs just spontaneously from doing business. The first one listed there being trade credit. Trade credit is just your accounts payable. It's just where you order from your suppliers and your suppliers automatically extend credit to you. The second one, accrued expenses, that occurs just, as you're closing out your books for the year or for the quarter, and you have incurred expenses up to that time, but they're just not paid yet because they're not due yet. So in essence, you can think of it as a short-term loan until that money is actually due. A good example of that might be like your credit card. You accrue expenses on your credit card, and it's a short-term loan, but then it's due at a certain time and you have to pay it then, or otherwise, in the case of a credit card, you would then be paying interest. Deferred income, sometimes you might offer a service or a product, and you are paid for it before you actually deliver the product or deliver the service. And so it's a liability, but you can think of it in terms of a short-term spontaneous loan, because basically you've already been paid for something you haven't delivered yet. And then there's negotiated sources of short-term credit, such as bank credit, which would just be like a line of credit that the bank would extend to you based on how much revenue you bring in. Commercial paper, which is issued and sold on the money market. Receivables loans, that's when a company can get a loan against their accounts receivables. Those are more expensive. Those are less desirable usually than doing bank credit or commercial paper. And then inventory loans, and that's where you have a line of credit and you're putting up your inventory as collateral for the loan, as opposed to the receivables loans. This time you're using inventory. So those are the various short-term lines of credit that are available. So that, in a nutshell, kind of gives you an overview of exactly what we mean by working capital management and some of the very basic policies that we look at. And you get to see a little bit from the asset side and from the liability side. Thank you.